Welcome to the deep dive. Today, we are digging into Dolby Laboratories, ticker DLB.
Yep, their Q4 and full fiscal year 2025 results, which just dropped on November 18th.
And here's the puzzle we're trying to solve. Dolby beat earnings, beat revenue, and even raised their guidance for the future.
And still, the stock dropped 2.2% right after the news.
So our mission is to figure out what on earth the market was seeing that we didn't.
It's a classic case of a nuanced report. When you see strong headline numbers but the stock doesn't move, you immediately have to question the quality of the earnings.
Okay, let's unpack that. Starting with the Q4 numbers, just how big was this earnings beat on the surface?
On the surface, it looked like a blowout performance. Dolby reported adjusted earnings of 99 cents per share for the quarter.
99 cents, and the consensus was what?
Much lower. Analysts were sitting at 70 cents, so that crushed it.
Okay.
And revenue was also a bit ahead, $307 million against a $305.76 million estimate. Solid numbers.
That really does sound like a decisive win. So where did the skepticism creep in? Because hitting 99 cents when the street expects 70 should send a stock soaring, not dipping.
The devil, is always in those non-GAAP DCLs. And here's the first major complication.
Okay.
That big earnings beat. It was heavily assisted. We have to note that the Q4 results had a huge non-GAAP benefit from some discrete tax items.
And that benefit alone amounted to what?
28 cents per diluted share.
Wait a second. So if the total beat was about 29 cents, 99 minus 70, and 28 cents of that came from a tax item.
Yep.
That means the core operational beat was essentially 1 penny per share.
Exactly. When investors talk about quality of earnings, this is what they mean. They're looking for sustainable, recurring profits from the actual business.
Not one-time tax adjustments.
Right. They're perfectly legitimate, but the market just sees them as ephemeral.
Yeah.
So the fact that this tax benefit made up almost the entire beat, that's a huge red flag for anyone focused on core momentum.
Okay, so that's the first and maybe the biggest piece of our puzzle. The market didn't punish them for bad results. They punished them for a low-quality beat.
Precisely.
But let's look past that one quarter's accounting. What about the full fiscal year 2025? That should give us a clear picture of their health.
It definitely shows a business that's moving in the right direction. For the full fiscal year, total revenue climbed to $1.35 billion.
Which is up from what, about $1.27 billion last year?
Right, a healthy increase from FY24. And profitability, non-GAAP net income was $414 million, which works out to $4.24 per share.
Up from $3.79. That's a solid jump.
It is.
And we have to talk about the cash they actually generated. That's key.
Absolutely. This might be one of the strongest parts of the whole report and something that should have made investors feel better. Cash flow from operations grew tremendously.
How much?
It leaped to $472 million. For comparison, it was $327 million in FY24. That kind of jump in actual cash generation is, a fundamentally robust sign for a licensing business like theirs.
So the full year showed strong revenue, better profits, and amazing cash flow. That should have balanced out the skepticism over the Q4 tax thing.
You would think so.
Which brings us to the future, fiscal year 2026. If the year was so strong, what was the market worried about? Let's look at the forward guidance. Maybe that's where the problem was.
And this is where the paradox just gets deeper, because the guidance was also better than expected.
Really?
Yeah, management was explicitly optimistic for FY26. Their projection for adjusted EPS is between $4.19 and $4.34.
Okay, and the analyst consensus was?
Lower. It was at $3.96.
Yeah.
So they guided well above that. And on revenue, they projected between $1.39 and $1.44 billion, also beating the consensus of $1.35 billion.
Let me just get this straight. They beat the quarter, even with the tax help. They crushed the full year operationally. And then they guided higher than anyone expected for the next full year.
That's the picture.
So where is this so-called concern about the company's outlook coming from? It makes no sense.
This is where investors often get really short-term in their thinking. When the full-year guidance is strong, the stock falls. It usually means the market is obsessing over the very next data point.
The next quarter, Q1 of FY26.
Exactly. The one with the most immediate uncertainty.
And what did that Q1 guidance look like?
For Q1, they estimated revenue between $315 and $345 million, and adjusted EPS between 79 and 94 cents.
That's a pretty wide range, $30 million on revenue and 15 cents on earnings.
It is. And the company itself basically explained why. They acknowledged having reduced visibility.
That's the key phrase right there, reduced visibility.
Precisely. They cited uncertainty from macro effects, supply chain issues, international conflicts, the usual suspects. But even if the full-year number is high, that level of explicit near-term uncertainty for Q1, it can spook investors.
So they see that wide range as a sign of risk, a signal that maybe things are slowing down in the immediate future.
Yeah, they're essentially pricing in that uncertainty as a risk premium. It's risk aversion, not optimism, that's driving the trade.
Okay, let's pivot away from the accounting then and into the actual growth engine. This is where it gets really interesting for me because management clearly has confidence.
They do.
The CEO, Kevin Yeaman, he credited momentum in specific areas. What patents, what products are actually driving this growth into FY26?
So the core drivers are still Dolby Atmos for audio and Dolby Vision for imaging. But the strategy is all about diversification now.
Right.
The CEO highlighted momentum in a newer product called Dolby OptiView and, I think critically, a new imaging patent pool aimed right at content streamers.
A patent pool for streamers? That sounds like a big move to monetize all the content being made for Netflix, Peacock, and so on.
It's a huge strategic play.
Let's break down some of the specific wins, because these are things you can actually see in your daily life. It's not just about high-end TVs anymore.
That's the whole shift. They're embedding their IP into content creation and social media. And on that front, two huge announcements.
What are they?
First, Instagram for iOS became the very first Meta app to support Dolby Vision.
So you can now capture, share, and edit in Dolby Vision right in the app.
Yep. And second, Douyin, which is basically TikTok in China, also enabled the same thing. Capture, share, edit in Dolby Vision.
Okay, I have to pause on that because that's enormous. We're not just talking about licensing the TV you watch it on. They're licensing the creation process on platforms with billions of users.
It's a massive pivot. They're getting upstream. By cementing their tech in the mobile creation pipeline, they're building a foundation in user-generated content, which is a much higher volume and stickier licensing world.
And it creates this brilliant feedback loop. If you capture a video in Dolby Vision on your phone, you're going to want to watch it on a device that supports it.
It's a full ecosystem play. Exactly.
What about the more traditional streaming side, the Peacocks of the world?
Big wins there, too. Peacock launched NFL Sunday Night Football and NBA games using Dolby Atmos.
Live sports, that's a huge validation.
It is, because immersive audio for live sports has really lagged behind movies. This is a big step. Live sports is must-watch now TV, and adding premium audio is a strong statement.
Okay, but let's talk about the most exciting emerging market, the car.
The car is basically becoming an entertainment hub on wheels, and Dolby is staking its claim. They announced new deals with automakers in high-growth markets.
Oh, cool.
Like Maruti Suzuki in India, Deepol in China, and VinFast in Vietnam, so it's a global push.
And they're not just stopping at music playback in the car, are they?
Not at all. They launched the first-ever in-car game with Dolby Atmos, a game called Loner on Li Auto vehicles.
In-car gaming, so they're thinking way beyond just your stereo.
Right. They're thinking about the whole in-car entertainment ecosystem. And think about it. The ownership cycle for a car is way longer than for a phone, which means longer-term licensing contracts.
So if we connect all this back, management probably sees the Q1 volatility as just short-term noise. Because this long-term strategic shift, it's already well underway.
That's the narrative, absolutely. But to really get the whole picture, we need to look under the hood one last time at the metrics. Specifically, where the money comes from and the scale of that gap versus non-GAAP difference.
Let's do it. So licensing revenue is basically everything for them, right?
It's the overwhelming majority, $1.28 billion in FY25.
And when you break that down,
broadcast is still the biggest slice at 34%. Mobile is next at 22%. And then consumer electronics and PC are tied at 12% each.
That 34% from broadcast, that explains why the push into mobile and auto is so critical. They need to diversify away from that.
It mitigates the risk of the traditional TV market stagnating, for sure.
But was there any sign of a slowdown in that core licensing engine in Q4 that might have scared investors?
Yes, a minor one, but the market can magnify these things. While the full year was up, Q4 licensing revenue was actually down slightly compared to Q4 of last year. $281.6 million versus $282.7 million.
It's a small dip.
A very small dip, but a sequential deceleration in your core business, paired with the Q1 uncertainty and the tax-assisted beat. It all adds up to that overall market pessimism.
That paints the full picture of the friction. Now, back to the quality of earnings, that huge gulf between the GAAP and non-GAAP numbers.
Right. And the scale of what they exclude here is massive. Management uses non-GAAP to focus on what they call ongoing business operations, but that means they strip out very real, very material costs.
So what was the scale of that exclusion for the full year?
It's huge. The official GAAP EPS by the strict accounting rules was $2.62 in FY25. The non-GAAP number they emphasized was $4.24.
So they excluded over $1.60 per share in costs.
Yep. So when they give that strong guidance for FY26, that 419 to 434 EPS, you have to remember that number relies on excluding a ton of expenses.
What are the big ones they're excluding?
It's usually three major things. First, stock-based compensation paying employees with shares. Second, amortization of acquisition-related intangibles. And third, any restructuring charges.
For the listener, what does it mean that they exclude stock-based comp? I mean, that's a real employee expense.
It is a real cost of doing business. They argue excluding it gives a clearer picture of cash profitability, but for an investor who cares about ownership dilution and total employee cost, it's absolutely real.
So the high non-GAAP number reflects management's optimism.
But the much lower GAAP number and the fact that the Q4 beat was mainly from a tax benefit. That means investors who are stricter about accounting are just seeing a much flatter story.
And that flat valuation view is what led to the 2.2% dip.
They're essentially saying, show us consistent core operational growth, not financial engineering, before we'll value you higher.
So wrapping this all up, what have we learned? We've seen a business with great operational growth in FY25, strong cash flows, and it's all fueled by a successful push into mobile, auto, and other new markets.
But the stock got dinged anyway. And that penalty comes from investors just laser focusing on the short-term quality of earnings, the tax benefit, and that wide Q1 guidance range. It's a classic case of the market prioritizing predictability over a one-off headline beat.
It's fascinating. So here's the final thought for you to mull over. Given the successful push into new areas, automotive, social media, live sports, does the future of Dolby's business rely less on just selling TVs and home theaters and more on cementing these new diverse licensing deals in gaming and in-car entertainment?
The revenue mix is fundamentally changing. That's the long-term story to watch.
Absolutely. That strategic shift seems to be the real narrative, no matter what happens in Q1. Something to think about the next time you see that Dolby logo pop up, whether it's on your phone camera or the screen in your car.
Exactly.
That was the deep dive on Dolby Laboratories.